Welcome to Profit in Your Pocket, where you learn how to implement profit first in your own business. Today I'm talking about the instant assessment. Now, the instant assessment is a tool that you can use to work out what percentage you're at with your business with each of the amounts that need to be allocated to each of the accounts. So the first step is to look at the real revenue calculator. Now, real revenue is a way of calculating not your top line income, not the amount of money that's coming into your account, but for those businesses who have materials or subcontractors that they need to pay out of that income, we take that off first. So with regards to materials, with regards to subcontractors, we have to pay those as a part of that income, and it's very job specific. So if you've got a subcontractor who you're paying 30%, who is creating income for you all of the time, then you need to set aside 30% of that income for that subcontractor so that you know you can pay them when their bills come due. Same with materials. If you've got a stock-based business or you're selling cost of goods sold along with your labor to to your customers, then you want to make sure that in order to do the job, you've got the money put aside to pay for those materials. You want to be on a good wicket with your suppliers. You don't want them cutting you off because you've paid late. So you need to make sure you've got that money set aside out of your income. It's not really your income. It's just a part of that income is allocated for some other purpose before we work out what your revenue is. It's not the same as your gross profit on your profit and loss statement. We like to stick all sorts of things in your cost of goods sold, such as freight, potentially employee wages, and other things that come along with a job in relation to cost of goods sold. But what we're talking about here is purely the job-based materials or subcontractors that we need to pay as a part of getting that job. That's it. The rest goes into operating expenses. Right. Once we've worked out what our real revenue is, and for some service-based businesses, this is your income, but for most trade-type businesses, you've got to do a calculation to get to real revenue. Once you've figured out what your real revenue is, then the table on the target allocated percentages, the TAPs, we need to figure out what income bracket you fit into. So if you're in the $0 to $250,000 mark, you're in column A. So you compare your business to those percentages. If you're in the $500,000 to $1 million turnover, real revenue turnover, then you'll look at column C, and so on. So those percentages are what businesses of your size are generally working at for a good, efficient business. Now, if your business is doing better than this, so your percentages might be lower for operating expenses, good work. But we find that most businesses who implement profit first, you're not at those percentages yet. So it might require a bit of calculation and rollout to gradually move up towards those targeted percentages. And that's absolutely fine. In my business, I'm not at that target percentages yet for everything. I am for some, but not for others. So we're working on it. Slowly but surely, every quarter we work out what the percentages need to be and move them a little further that way. Okay, so let's have a look at your business. Worked out the real revenue and what belongs in there. Worked out what the materials or subcontractors are and taken them out. This will be a separate bank account. So if it's a percentage you've worked out, then that percentage will be the first bank account that we know a percentage of, which is great. From there, What's left over is your real revenue, and where you split then that real revenue into the different bank accounts. So running through our profit. What is profit? Have you taken any money out of the business for yourself in the past 12 months? Now we look at all of these figures in the last 12 months or the last financial year that you've had your figures done for. If your bookkeeping's up to date and it's all fine, then we look at the last 12 months. You can run a report for the last 12 months in most bookkeeping software and it'll give you the answer. Or if that's not right, go back to your financial reports and we can look at the numbers from there as a start. How much money did you take out as profit? For a lot of businesses, that'll be a zero. Zippo, nothing. Oh well. The next one is owner's pay. How much did you take out of the business as a wage for the past 12 months? Now, if you've got yourself on payroll, well done, congratulations, not everybody does, then it's nice and easy. Look at your net pay that you've taken out of your of the payroll reports. It's your net pay that we want in your wages account or your owner's pay account. And the reason for that is because we're sticking the taxes and the super into the taxes and the super account in the tax account. So all we want to do here is have enough money for your net wages. So the money that goes into your bank account. If you're not very good at paying yourself a wage, you go, the business doesn't have any money to pay me this week, I just won't take anything out, or you're taking it as drawings rather than wages, put it in there anyway. Because what we want to do is create a system for you that gives you certainty over what you can take out of the business. So owner's pay is the money that you've taken out for your wages or money that you've drawn out of the business for your own personal living expenses. The tax account can be a little bit tricky to work out because it's not on your profit and loss statement. It's not in one particular area. So there's a couple of different cheats to find out how much you've spent for tax. If you're up to date with your BAS and you're up to date with your taxes, well done. Congratulations. Not every business can say that. So if you are, then the best place to find where you've paid your tax is the ATO portal or the online services reports. So you can run your integrated client account, you can run your income tax account and see how much tax you've paid to the tax office over the past 12 months. Now, we also include super in this account as well. So check your superannuation payable account on your balance sheet. Look at the transaction listing to see how much you've paid in super there. If this all sounds too hard, going and running different reports, go to your bank account. Run through your bank statements. Might take a little bit more time, but at least you know that they're all accounted for and there. Once you know how much you've spent in tax, GST, pay-as-you-go withholding, income tax, and superannuation, group them all together, add them up, and put them in the tax section. Our last box is our operating expenses. Now, you might just go, well, that's my total expenses on my profit and loss. Unfortunately not. What's included in your profit and loss statement is things like depreciation, which is not cash, interest, which is only a portion of the loan payments that you're making, not all of the loan payments, unless it's an interest-only loan. Please don't do that. And then there's other things in there like superannuation, wages, and so if your wages are on your profit and loss statement, you'll need to take them out because we've already included your wages in the owner's pay account, and the superannuation we've already accounted for in the taxes column. Generally speaking, your operating expenses is a bit tricky to work out, but once you're close enough is good enough. You do not need to get down to the last dollar to figure out what your operating expenses are. So please don't stress if it is not balanced. It doesn't matter. We're just getting a guideline, a percentage guideline of what your income is and what percentage of that income is paid for operating expenses, and for taxes, and for owner's pay, and for materials, and for profit. So what we want to do is, once you've figured out all of those numbers, what you've actually spent in the last 12 months, is compare them back to what the target percentages are for your business size. So working out your maths should be reasonably easy. If your taxes are $10,000 and your real revenue is $100,000, then $10,000 divided by $100,000 is 10%. So that would be the percentage, the PF percentage in the instant assessment. What we want to do is figure out what percentage should that be. So if you're in column C of the target percentages and your tax should be 15%, then you're short by 5%. And so you'll need to increase that over the time. Now, note, the percentages for 15% may or may not work for your business structure. So if you're a company or a sole trader, it may not be enough because you pay tax at different tax rates. If you're a trust or a partnership, these percentages might be enough for you because you don't pay income tax in those structures. The money flows through and the partner or the beneficiary pays tax at their tax rates. So just be mindful of that. Please reach out if you're operating as a company or a sole trader, and I can help you work through what's the right tax percentage for your business based on your numbers. So we're comparing your actual percentages against the profit first target allocated percentages. If you're not holding enough percentage, or if your percentages is too high as an operating expenses, we need to do some work. But we can't go, for example, if you're currently sitting at 65% for your operating expenses, but it should be 50% as per your target allocation, you can't just wipe yourself off unless you know you can easily get rid of 15% of your costs. Most businesses, you can get rid of 5% reasonably easy, but 15% is a bit tricky. It involves a bit of negotiation with staff, it involves negotiation with suppliers, it involves work to cancel things that you do not need, that do not make revenue in your business. So it's really important to not just start your percentages with the target percentages unless you're a brand new business. If you're a brand new business, start with those targets. The only way is up. But for most businesses who are coming in with existing cash flow issues, there's some tweaks that need to be made. So this instant assessment, by looking at what percentage it should be, what percentage it is, means that you'll have a fix to do. So a bleed is where you're hemorrhaging, where you're spending too much or not enough. Too much being too much on yourself, or not enough being not enough tax, not enough profit. Spending too much in operating expenses is totally normal for a lot of businesses. So we want to pare it back every quarter, make a change so that you're spending less on operating expenses and able to spend more in those areas that you need to spend more on. So, instant assessment. Work through it. Call out if you've got any issues or questions, and I'd be happy to do another video to explain a specific area. Now, if this is way too daunting for you and you're not sure that you can work it out yourself, then I'm happy to provide that service for you, work with you to make sure those calculations are done, and so you can move forward and you can implement profit first in your business. If it's scaring the shit out of you to do these numbers, then do not let this stop you. You need to reach out, we need to run through it together and implement profit first so that these numbers are no longer scary for you. It shouldn't be scary looking at your numbers in your business. If it is, you need to touch base today. Right. Let me know if you've got any questions. Run that instant assessment, see where you're at. Hopefully there's not too many holy shit moments of, oh, we need to make serious changes. But if there is, I need you to do them. Make those changes. I can't wait to see how Profit First transforms your business.